things are really, really expensive. Now, can they get more expensive? Yeah, but they're about as expensive as I've ever seen them. I've never seen, for example, a CAPE ratio at 40 and current earnings at 24 and a half. I mean, everything is really off the charts. So could it get higher? Yeah, it could. It might, but I think you have to think about this as saying that, I'm at least in the eighth or ninth inning. And when you think about it like that, maybe it makes you stop and think a little bit.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Short of a dramatic surprise in the next few weeks, the markets should end 2025 with another big double-digit positive return for the third year in a row. A string of three-peats like this is quite rare in the markets, which raises the question, can the momentum last in 2026? Or will the market's return start to mean revert? To discuss, we've got the good fortune of welcoming back to the program high net worth financial advisor Ted Oakley, managing partner and founder of Oxbow Advisors. Ted, thanks so much for joining us today.
Good to see you, Adam.
Ted, it's always such a pleasure to have you on here. I'm very much looking forward to this discussion. It's been too long since we've had you on last. A couple quick housekeeping things before we get to the meat of the discussion here. One, this is the first interview that I've recorded since I broke a tooth this past weekend and had to have an emergency tooth extraction, which was not fun. I'm doing fine now, but I will admit I'm very self-conscious about this gap that has been left, and I'm going to get a replacement tooth for it, but it's going to take like over half a year. It's crazy how long apparently this takes. So anyways, I am more than a bit self-conscious about this. Hopefully folks won't see it while we're talking here, although eagle-eyed people might be able to find out exactly which tooth is missing, but I'm not going to share which one. But anyways, if I seem a little out of sorts, it's because I'm trying to figure out how to talk without showing the gap.
Well, I haven't noticed anything. If you hadn't said anything, I would never know.
Okay, well, that's good to know. And just to make it clear for folks, it wasn't like tooth decay or anything like that. I literally just broke the tooth. And they said, look, your teeth were really healthy, which was what made the extraction so hard, because the rest just didn't want to come out. But anyways, thank you for that. Also, we'll talk more about this at the end of today's discussion, Ted. But you and the Oxbow team will be doing a free webinar for the Thoughtful Money audience next week on succession. Basically, if you are the one who is managing all the finances and the investing for your family, that's fantastic. But what happens if you can't be there anymore? Either you get incapacitated, you pass away, whatever, you decide just to give up the reins. It's something that a lot of this channel's viewers who are DIY investors wrestle with. They don't necessarily have a family member that they can hand that responsibility to. And so the question is okay, well, what do you do in those cases? So this is a topic of which you are very well experienced at Oxbow. And I believe we're going to be doing this webinar, I believe it's this coming Monday. That's December 15th, and we're doing it at 7 p.m. Eastern, correct?
Correct, right.
All right, and folks, if you're interested in attending, it's a free webinar. You can go sign up for it at thoughtfulmoney.com/succession. And again, folks, we'll talk a little bit more about that at the end of this discussion. But at this point, Ted, let's just roll up our sleeves and dive in. So I mentioned in the intro there, we've had three really robust back-to-back years of double-digit returns for the stock market. Is it likely that can continue into 2026, especially given whatever your outlook for the markets is? And maybe why don't we start there? What is your outlook for the economy and the markets right now as we head into the next year?
Well, Adam, it looks like, we'll be a little bit slower because, obviously, employment slowing down. That's one of the things that drives it, which probably, we may not notice it in the numbers here. We usually don't during Christmas and that period because people, for some reason, they dig down deep to make it happen. But next year, you're probably going to have lower employment. And when that happens, it'll have some impact on the marketplace. It wouldn't surprise me since we're ending the year like this, to have this roll on into the first quarter and be a pretty good quarter. I do think there's a spot in 26 where you hit a more significant high, probably, and then you have a bit more of a setback. But that could be second or third quarter. I don't know. But, things are really, really expensive. Now, can they get more expensive? Yeah. But they're about as expensive as I've ever seen them. I've never seen, for example, a CAPE ratio at 40 and current earnings at 24 and a half. I mean, everything is really off the charts. So could it get higher? Yeah, it could. It might. But I think you have to think about this as saying that, I'm at least in the eighth or ninth inning. And when you think about it like that, maybe it makes you stop and think a little bit.
All right, eighth or ninth inning. Okay, so that's got to make you feel like at some point, I'm guessing in 2026, you get to the end of the ball game. And as you mentioned, I think you said, yeah, maybe it could get a bit higher for a while, but then you expect it to have some sort of correction. I've talked with you long enough, Ted, to know that you have had a lot of concerns about the level of valuations. And so when you said that it could do well in Q1, could go even higher after that before things head downwards. Are you envisioning sort of like a blow off top? A lot of people have called this the everything bubble, and most bubbles end with a incredible but very short-lived mania where the prices just go higher than anybody could imagine for a brief period of time. Are you expecting something like that, or maybe something a little more pedestrian?
Well, it's more along the line. You got to remember all the 401, a lot of 401k money gets put in the market in January in the first quarter, and there's a lot of that happening now. And those people aren't thinking at all about a sell-off. They're just driving it into the market. So you'll have that happening. And then you'll have a bit of probably just inertia from, this year going into the first quarter. And yeah, you could have a peak. I mean, if I were looking for more of a generational top, I wouldn't say necessarily 26, but I'd say sometime happen in 26 or 27, because by that time you're almost a generation past the '08 low. And so you've got a whole generation that's never seen a really more significant bear. And so you got to remember that the market has a way of taking every generation and sort of humbling them down somewhere along the way. And I suspect that'll happen in the next 2 or 3 years.
Okay, and let's talk about that for a moment because you have been, in money management for a number of different cycles. And we've talked about kind of what a true bear market looks like. And correct me if I'm wrong here, but I don't think you don't think we've really seen a bear market since '08. 2022, sure, that was a rough year for investors. But on some long-term trend lines, we didn't really break below the long-term bullish trend. And it certainly didn't end with the kind of capitulation that I've heard you describe a true bear market has, which is when nobody wants to touch a stock and everybody just sort of swears off them for a good number of years. So I guess my question is, are you expecting when we get to the end of the ninth inning here, whether it's 2026 or 2027, that will be because we are entering a true bear market?
Well, I suspect so. Number one, if you look at demographics, by that time, 27, you'll have the average baby boomer be 72 years old. They're going to be taking money out of the marketplace. But the other side of it is that these things come and go. We're two standard deviations plus above the norm on these averages. And I don't think I've ever seen a level of complacency, even in the late 90s, any higher than it is today. I don't think investors generally wake up every day and even remotely think about anything that could be bad happening in the next year or two. They just stay the course and put more money in the same way. And I think the advisors do the same thing, which is one of the problems you have. But that's when you get everybody on one side, like we are now, and the economy runs on the market, then you got everybody basically set up for something that's probably not going to work in the long run.
Okay, so the way you're describing this, here's sort of how my brain is thinking, which is we have this very high degree of valuation and complacency that you just mentioned, right? So markets are very rich and nobody's really worried about it, about a downturn. Um, uh, we have the potential, as you've said here, for the jig just to be up, and eventually we enter into some sort of correction here, and so that could be a real surprise for people because, to your point earlier, um, I mean it's been almost a generation of investors since the '08 Great Financial Crisis. So you have these people that just, I mean, how long ago was that? That was
Yeah,
17
16
years
or
ago.
17. Yeah, yeah,
Yeah.
17.
So you've got a bunch of investors, retail investors, and you've had a bunch of Wall Street professionals who now have spent, a good chunk of their career and never been through a true bear market, right? So, you know, you've got high valuations and complacency versus the inexperience of knowing what to do with the bear market when one arrives. And then you're adding on top of that, this dynamic that I've talked a fair amount with housing analysts about, but I haven't talked to too many people in your line of work in terms of money management about it, about the boomers. Uh, in the housing market, you're looking at kind of like 20 years, or more, which is kind of the cohort of the baby boomers, of sustained selling pressure as boomers get to the age where instead of, for the past bunch of years, we've been having 10,000 of them hit retirement age every day. Pretty soon, and really even probably starting around now, you're getting to the point where 10,000 of them are having to downsize their house, either because they're heading off to the nursing home or because they're dying, right? And that's going to sustain for a long time, as I said. So that's going to have a lot of downward pricing pressure on the housing market because in a lot of cases, when a boomer leaves their home, the house gets sold, especially if they have multiple kids, because the kids don't know who should get the house. So they just say, you know what, let's just list it and let's split the proceeds. Is there an analog to that in the stock market where boomers are dying with their portfolio and then the portfolio has to be distributed? Is there any sort of selling pressure component associated with that?
Well, I think the selling pressure comes more at them from taking care of them. As soon as they start waning as far as health or go into assisted living or that sort of thing, they start burning cash then. It's
Okay.
not like before. And so, the children or whoever takes care of it has to start liquidating to take care of that. And then they run into maybe some major things where they have to really spend a lot of money on health. I think that's one of the driving things. Secondarily, yeah, there'll be some of that fallout. But the thing is, when you have, no matter what, when you have everybody that owns the same thing, then all your buyers are in, you see, no matter how you want to calculate it. And
Yep.
so the next thing is when people start to realize they need to sell something and you flip it and go the other way. And I've been through that before. You get up every day, the market's down and it rallies in the morning for an hour or two and you think, hey, it's going to come back. It never does. It's sort of like it is now in reverse. You get a down day and everybody's no big deal. We'll be up tomorrow, the next day. And
Mhm.
that's what's happened. That's why people are complacent. But you flip that scenario in a bad market.
Well, so you flip it in a bad market, and again, you've lived through a number of different market cycles. What you're talking about here, maybe I hate to use the word different this time, but maybe a bit different this time because I think you're familiar with Michael Green's analysis of passive capital flows,
Yeah.
and he talks about the passive bid, and he's done a lot of really rigorous research to show that it's a big factor in stock prices. In fact, maybe the dominant factor right now. And he's almost kind of depressed by this, but he's like, I think it's going to continue for as long as passive capital flows are positive. But if they flip negative, which they likely will at some point, then watch out because you're going to have this sort of sustained selling pressure, just like we've had this sustained buying pressure for the past, couple of decades from it. So, as the boomers, to your point, as they're starting to get sick, needing to cash out on their financial assets, that is, like I said, maybe, 20 years or so of just relentless selling, and that may be what pushes passive capital flows into negative territory because rather than putting in, they're taking out.
Well, it could be. I mean, people are, they don't take losses very well.
Hmm.
So, if you start turning the tide on them and go the other way, then what happens to them is they say, well, I need to sell now before it goes lower. And it's a snowball effect is what it is. And, again, I think people have basically come to the conclusion that you're never going to happen. I mean, that's basically what I see with people doing. That's never going to happen, and so, you can't really talk rational with people because they're basically irrational right now.
Hmm. Okay, so we've got people thinking, all right, it's going to be summer forever. You're raising some issues that say, hey, look, winter's going to come at some point and could come as soon as next year. Um, I'm going to get to in just a second. All right, well, so how do you manage capital, which you have to do in this environment? And I don't think it's a go to 100% cash and just sit there environment, at least not yet. Um, Before we get there, though, let's talk about some things that are happening the moment that we're talking here. So the day that we're recording this, silver just broke out above 60, $60 an ounce. And silver's been on a tear all year, as has gold and the mining companies. Bitcoin is also surging today. I think both silver and Bitcoin today are up
Mhm.
about 4%. And I think one of the reasons for that that's being touted in the markets right now is people are thinking that they're sniffing out that the Fed is actually going to be quite dovish when we get the FOMC release tomorrow and hear from Jerome Powell's press conference. Now, by the time this video comes out, folks will know what Chair Powell has said. But anyways, curious to hear your thoughts right now on kind of the rallying in the precious metals, whether you think the Fed is indeed going to cut tomorrow, what you think the Fed's going to be doing in 2026, and then we'll get to a couple of other asset classes too that are on the move.
Well, we own silver and we own silver miners, have for a long time. I say a
Hmm.
long time, for a couple of years, but um, we we had, we knew that, if you look at sort of a real prices adjusted for inflation,
Hmm.
silver is not anywhere close to where it's been a couple of other times.
Right.
So you could still get a lot more out of silver. And I think all the metals really offer, it's getting to one of those things where countries hoard everything, Adam. And
Hmm.
so they're hoarding everything, every metal you can think about, every precious sort of mineral you can think about. And that's becoming a big deal. And I think in the other side of that is that, they're just buying that instead of other things. How long does it last? I don't know. These things don't usually last a generation. They're normally like, you know, 4 or 5 year moves, but we can see. But I mean, well, like I say, we own silver, we own the miners, and also some of the royalty companies that have silver on the royalties. But uh, just have to wait. Now it's broken out a new territory here, price wise. You'll have to see how people chase it. We're starting to see a little bit of chasing. Not a
Hmm.
lot though. Institutions don't own much of it, but individuals are starting to go the other way with it.
Yeah, and do you expect the institutions to jump in before this run is over? As you and I have talked about, I think over the years, Wall Street's not a big fan of gold and certainly hasn't been of silver for a long time. But more than anything, Wall Street loves momentum and the ability to make profits. And when there's a party going on, eventually it likes to join.
Well, I think the miners got really, if the miners do really, really well and they're left out, I'm talking about Wall Street's left out of that, then the thing they would do is chase it. And that's usually what they do with any asset. They chase it at the top and just drive it higher. And that's when you see the volumes go up really, really big, then they're coming for that sort of thing. Same way with gold miners. And we haven't really quite got to that point yet. We got a little bit in gold mining here a few months ago, but the chasing's kind of slowed down a little bit right now. And generally, I don't see the institutions just trying to buy hand over fist in there.
Okay, but right now you're not changing your allocations. In other words, at least you're not selling your allocations, it sounds like.
No, we sold some of the miners about a month ago. Not a lot, I mean, but when you get large moves like that,
Right.
you know,
100% this
yeah,
year,
100,
a lot of them.
in some cases 150, 200%. You have to, you need to, at least in this case, take some off because you're not dealing with a company that's making widgets or making a product that's going to be around for, 20 years. I mean, these commodity cycles come and go, particularly in the metals. And when you get that kind of move and it just been sitting there for years, then you have to take some of it off the table. You
Mhm.
should, I think.
Okay. Um, I know we've talked in the past, you have said you don't really think it's sort of a 60-40 world anymore. And if I remember correctly, I think it was a 60-30-10 was sort of the new model you guys were taking on at Oxbow. Am I getting that correct?
Well, we had what we call a 30-30-30-10. We had
Sorry, that's it. That's it. I
yeah,
knew I was misremembering. Okay, yeah.
and we sort of have that now. We have, you know, 30% in short-term treasuries. By short-term, I mean less than 30 months. And then, 30% in basically in commodities or commodity-based things, and 30% in stocks. And that can be a value or growth company, and then about we think you need to keep 10% or more just for trading purposes. In other words, you're going to have situations where things get really cheap. We've had a lot of things get cheap this year that we stepped in and used cash on. Not necessarily household names that you'd see every day, but things that were really, really good buys. And I think that's what you have to do in this kind of atmosphere. I think the idea that you can buy a long-term bond now is not a good idea. Uh, I see people generally losing money on those for a long time. And to me, if you're buying 20 or 30-year bonds, you're making a big bet on the fact that they can keep inflation in check, but I doubt that they can, over the long run. So that's why we wouldn't step out past, 24 or 30 months with the Treasury.
Okay, so let me just make sure folks took note of that. So the 30-30-30 allocation, 30-30-30-10 allocation that you think is more appropriate now is short-term safe debt instruments that are producing some income, stocks, commodities, all of those at 30%, then 10% basically dry powder to take advantage of opportunities as they come up opportunistically. You don't like long-term bonds I'm going to guess, kind of for the foreseeable future. My question on that is, and we'll tie this back to what the Fed, may do this week, is the Fed is in cutting mode again, and there's people out there that say, hey, look, if the economy is going to slow next year, as you think it likely may, Ted, that if it slows too much, at some point we're going to get all the intervention, the central planning intervention to try to, rescue things, and that at that moment, that will drive bond yields down, that will drive the prices of bonds up and the prices of longer duration bonds up even higher. So, that's sort of a short-term opportunity. Do you think that could happen? Do you think that that's not worth playing? That's more like trying to catch nickels in front of the steamroller, um, or is that a real opportunity?
Well, I think you're right on the short-term rates go down, but I don't think the long-term rates go down. To me, I think people will say, hey, I don't trust you, Federal Reserve or federal government.
Hmm.
They were going to try to keep this in. Look at it right now. The 10 years stuck on 415, 420. You would have guessed with all the talk and everything we've had about lower rates and coming up here, on the decision that you would have seen that change as well, but it didn't change. And it's worse though on a 30-year bond. If you say, okay, I'm going to buy a 30-year bond today and I'm going to say that I'll take 4 3/4 for the rest of my life, basically for 30 years.
Hmm.
I think that's a bad move. I mean, that's a long time, number one. And number two, you're betting on a government that's basically flat broke and going to be more broke. So to me, that's the worst of all situations.
Okay, I totally get that logic. Okay, So, do you expect, and again, I know viewers will know the answer to this by the time they're watching this, but at Oxbow, are you guys along there with the market expecting the Fed to cut tomorrow?
Well, I just assume from reading that they would, if you
Mhm.
see the people that have come. It's interesting, Jay Powell hasn't said much the last 2 weeks, but everybody else has been talking. He hasn't said much, and I guess he's just sort of waiting to see how the votes check out. But
Mhm.
it looks like that's what's going to happen. I don't think they need to, Adam, but it looks like if you think about it, we're one of the few countries, us and the Bank of England, that are cutting rates. Heck, everybody else is raising rates. I mean, look overseas. I don't know what we're doing. We obviously don't have a Fed that's independent, but we're in a different mode right now. And for them to be in and come in and get aggressive on the downside, it's just all political, and
Yeah.
it'll end up blowing it up again with inflation eventually.
And do you expect the lack of independence to increase as Powell gets replaced with the president's, latest appointee?
Well, it sounds like he wants a rubber stamp Federal Reserve, which is not good, really. They need to be able to do what they think's the right thing to do. And, there'll be a bunch of name calling as usual and all that sort of stuff, but it's not good. In the long run, they need to be able to look at the two things they're set up to do. But I think what's happened is between the Federal Reserve and the federal government, the last 25 years, 30 years, they've gotten so accustomed to saving the stock market, and the
Hmm.
stock market was the only thing that keeps the economy going, that they're stuck. And so they're probably going to do whatever they need to do to make things go, which may be lower rates significantly, but the hangover from that won't be good. That's the point I'm making.
So let's talk about that for a moment. So, we started this conversation with you talking about how richly valued the markets are.
Mhm.
And something that we've talked about in the past has been sort of the resultant K-shaped economy, right? Which is that the people who have assets have been doing great, where the majority that don't have many assets, especially financial ones, are getting increasingly left behind. And it's that top end of the K that's really doing the lion's share of consumer spending these days. So if we do get to a point where there's a substantial market correction, then you have a big negative wealth effect on that top end of the K. And then that impacts the economy. To your point, we've gotten to the point where the stock market tail is now wagging the economy dog. So yes, you expect the central planners to kind of rush in when things are starting to come off the rails and do whatever they can. But as you said, there's going to be a hangover process there. How bad do you expect that to get?
Well, what happens is, I think it'll look more like the Arthur Burns era of the 70s, where he would lower the rates, thinking that we're going to really get this thing going, and then inflation would come back, so he had to come back and raise the rates, and so that was sort of an experiment for 4 or 5 years.
Hmm.
And Burns was horrible as far as he didn't do the right things, and finally, really, Volcker had to come in and clean up his mess. And my guess is you'll have some instant, something happen. I don't know, in the next year or two, and it changes all of that. Where they can't they can't affect things as much as they used to be able to with just lowering the rates.
Hmm. Hmm. I've had a number of people on talking about sort of the point you get to, at least with monetary policy, where you're pushing on a string, where kind of no matter what the Fed tries to do, monetary policy, QE or whatever, it doesn't, you get the laws of diminishing returns where it just does less and less.
Well, I think too they'll just keep on printing. Because we have nobody in Congress, not at either party, no person. You never hear them talk about, we need to slow down spending and maybe look at this or look at that. It's just a spending spree. What have you done? It's all about themselves, really.
Right.
And we just spend money and waste a lot of money. And until something happens that'll bring you to your knees, like a World War II or a depression or a crash, something that you're not expecting, COVID, some things you're not expecting, then they can't control anymore. And I wouldn't be surprised if it's not something like that. I don't know, but there'll be a point where they can't control the outcome as well as they expect.
Okay. We're talking about some dark things. Let me try to channel the administration for a moment. At least Treasury Secretary Scott Bessent, who would say, "Hey, Ted, we've been working really hard here in 2025 to pass all the legislation we need to really start getting this economy goosed and strike all the trade deals and start reshoring jobs and bringing trillions of foreign capital in here, and we're deregulating and we're getting all this 30 plus billion of tariff revenue now every month. Like, just have a little bit of faith, man. Middle of next year, man, we're going to be firing on a bunch of extra cylinders here. It's going to be great." What do you say to that?
Well, the first thing I would say is I was talking to Mr. Bessett. Is Mr. Bessett, how many times have you had faith in the federal government for start with? Number one, but number two, I think manufacturing jobs. And I may be wrong on this, but I think they've actually declined a little bit this year in the U.S., if I'm not mistaken. I think I've read that a couple of times. But the other side of it is they do these things and get back, like this $12 billion. They're saying they're giving back to the farmers. Well, they took it from the people that pay the tariffs. The whole thing is, see, that's crazy, that whole thing. And then you come down hard on China, and then you realize, hey, China's got the cards, we don't. And then I've got to go over and be a nicer part. See, all of that's it's just grandstanding, and it doesn't work in the long run. I do think this about what Scott Bessett thinks. I think deregulation is better. I think they've done that. I think they've done a great job on energy, on the way they're approaching it. They've got a really good energy secretary. I think there's 3 or 4 things that they've done that are better, be better for the economy. Whether it all pans out that way, I just don't know. We've run so hot on AI that if it slows down, then what's left to pick up the slack? I don't know. And
Okay.
I'll tell you, that's one of the reasons when we're buying companies, we just look at the company. We don't try to buy the averages or indexes or things like that, because that's all macro. But if I can take a company and look at it, I can tell you where we can make some money in that company, I think, over the next 5 years.
Okay. So fair to say your approach is a bit more of a Buffett type approach, where you're just looking for great companies that produce great cash flow and hopefully try to buy them at a good valuation.
Totally. That's what we do. And when you're doing that, you take yourself away from having to determine, what we're going to do on the world market and what's going to happen with the Fed. You're just looking at a value of something. It's a really good value, and you're saying, okay, I'm going to own that for various reasons. There's some really great buys this year. I don't think the average person bought them, but there's been some really great buys this year, and I think people miss that point. They just keep driving into the indexes, and the indexes are controlled by just a few companies, so they never get a chance to really own what I consider to be some really, really good businesses.
Okay. Well, let's talk about those great businesses that you picked up this year. And the other question I was about to get to, especially since you mentioned energy as one of the areas where you think the administration's doing well. I'm very interested to get your thoughts on the energy sector as an investment class, because it's been a real disappointing one for many years. But there's a lot of talk, at least amongst the folks that I interview now, that it might be starting to turn. This might be a good time to be investing in and try to catch its upswing. So answer that however you'd like, because I'm going to guess some of the companies you bought this year might have been in the energy sector, but you tell me.
We bought a lot of energy this year, but it's interesting. I know generally people are off on it, but most of our energy investments this year are up for the year. They might not be up 40% or something, but they're up from where we bought them. And if you look at the energy sector, to me, over the next 2 or 3 years will be the best buy you can make right now. Because if you look at the dividends in that group, there's a lot of them that have 7, 8, 9% dividends. And, we just bought Petro Brazil, 12% dividend, biggest oil company in Brazil. I mean, all you got to do is get a turn. You have to realize you go much below $55, $56, and they won't be drilling. They won't be doing anything. You have to make enough money to do it. So, it's still a supply demand thing. And granted, you might be in a situation where for the next 5 or 6 months, you're just collecting the dividend. But if you look at that total return over the next 2 or 3 years, you're probably going to do really, really well. I mean, we bought numerous things this year in the energy section. There were dividends anywhere between 6 and 10, and that's great cash flow right now for this time we're in.
Okay, so I know that like nuclear plays have done great this year, largely banking on a lot of future investment by the country in this space. But a lot of the actual cash flows from that are years and years in the future. Oklo is a great example of that. They're not going to have a dollar of revenue for many many years, but the stock's
Right.
done fantastic this year. I assume most of the companies you're talking about that you're buying this year are more in the fossil oil and gas space.
Natural gas and oil. I mean, I think if you look at solar, for example, the way we've sort of played solar is we own silver, use a lot of silver in solar.
Yep.
And so we kind of go that different direction. But generally, we're oil and gas. We own one small company that's in the service business in the Mid East. That's a great little company, uh,
Hmm.
National Energy, NESR. So all of you out there, but it's a small company that makes a lot of money. Just signed a big contract, but that's the only service company we own. Everything else we own is either is really oil or gas, and gas has done really well for us this year, really well. But I think it'll do a lot better in the future. And so that's really where we are. We're if you look at what we've added the most to, it would be energy this year.
Okay. I just got to ask since you mentioned it. I've interviewed again folks who invest in this space, and a lot of them have been pretty bullish on the midstream companies. But
Mhm.
sounds like you guys only own one. Why only one?
Oh no, we own 3 or 4. I didn't mean to imply that. What I mean is we own the gas producers that are not midstream. They're
Mhm.
actually producing it. We own Antero, for example, Northern Oil and Gas. We own Apache or APA, which are the old Apache. But we own. If you look at what we own in the midstream, they're mostly LPs, but MPLX. If you look at Energy Transfer, Enterprise Products, see those are all paid on a K1, but our average yield on them is somewhere around 7.5%, which you can't get today, Adam, in a real estate deal. I mean, I mean,
Right.
I think, and they raise it every year, and so they've been great. We've owned those for many, many, many years. I'm talking about 20 years now, and a lot of them. And so, it's that's an area that if you look at Enterprise Products, we've been on that stock a long, long time. It's been a great company, but we own those are the midstreams we own. But they're almost all of those are an LP and they're on a K1, but we own the straight up gas companies too. And that's why we own when you look at on the oil, we sort of separated on the oil, but we own various oil companies, Matador, like I say, we just bought Petro Brazil, and it's a good group. I mean, it's a group where you can make some money. We think the next 5 years, but you got to stay with it.
Okay. Well, thanks for clarifying. And I've been a silver investor forever, but I got quite bullish on silver when we had the price breakout at 35. And I know you follow me on X. You probably noted where I gave myself silver eyes at that point, and then one of my followers added laser beams to the eyes. So I've had silver laser eyes since 35, and that's proved out well now that silver is above 60 on the day that we're talking here. But I've been saying of late when I retire the silver laser eyes, I might replace them with oil eyes because of the potential for this industry to turn. And I think you share that optimism. Let me ask you this, Ted. Your firm is headquartered in Texas, so you know a lot of people in the oil industry. How much of your enthusiasm is because of your approach to valuing companies and just doing the homework you guys do on the fundamentals versus what you're hearing from people in the oil industry about their sense of its prospects in coming years?
Well, I think they generally feel good, and we've seen that business shift a lot on the private side. You see a lot of mineral business. In other words, a lot of royalty overrides, that kind
Hmm.
of thing, and they're making, and it's big. Everything's big now. It's not like you can't go drill a vertical well like you used to 30 or 40 years ago, and I hope you get a good well out of it because everything's horizontal. All the horizontals are getting longer and longer.
Right. Well, the easy stuff was extracted a long time ago. We got to go
Yeah.
deeper and deeper. Yeah.
Yeah, but that's kind of where the business has gone to. But I still say this, that they need a price to really expand that. They need a price, and it's not like they're not doing anything. But in the long run, a higher price is going to really expand that, I think, to a high degree. And so in the industry, and I hope people don't get irritated with him, but the oil industry is not a good industry for sentiment. At the lows, they won't buy anything.
Hmm.
At the highs, they think we're going up forever.
Hmm.
And so I used to laugh at a lot of them because I'll tell you a story back when the oil late 80s, it was, I guess it was, I can't remember exactly the time, but oil was, um, had gone down, it had gone down to about $10 a barrel or 11. And I asked this one oil and gas guy, I said, what do you want to just go out and buy it? Because I said, well, how much does it cost to lift the oil? If you just drill the well, he said, that's probably about 14 and a half, $15 a barrel. I said, why wouldn't you just buy it then? And he said, because it might go lower.
Hmm.
so, so if you think about, excuse me, if you think about that, it's kind of it's contrary thinking, but that's kind of what the industry does.
Okay. All right. So don't rely too much on the industry sentiment because they oftentimes get it wrong, especially
Sometimes.
at the edges. Um, so a couple quick things. So I think you already said this, but I just want to really make sure folks listening understand it. Given your optimism, I don't think it would surprise you if the oil price continued to drop for some material period of time here, say into the middle of next year. You're not calling the bottom in oil here. You're just saying you like the longer term prospects of this space. And even with a declining oil price, as you said, a lot of these companies you own are going to be paying you nice dividends. And then if and when the industry does turn, you'll get the best of both worlds, where you'll get those dividends and a rising share price.
Well, it's true because, at the top, oil was 30% of the S&P. And I don't know what it's 3.5% now,
Yeah, it's like
whatever
low
it is.
single digits now. Yeah.
Yeah. So what happens is, yes, it could go lower, but we would just add to holdings if it did, because we would be getting more cash flow. And in the end, that's what all investing is about, is cash flow, no matter
Right.
what kind of investing you're doing. But yeah, it could get weaker. It could get a little weaker. I wouldn't see it past 50, 55 though. I think you get down to that level, I think people they just stop.
Hmm. Well, I'm selfishly, I'm kind of hoping it weakens from here just because I
Mhm.
want to be able to dollar cost average in at lower prices in the near
Yeah.
term. I'll also say too, a lot of the natural resource experts that I interview, Rick Rule, being very notable amongst them. Rick says, look, if you look at the growth of world demand for oil and gas, it's just a ever increasing line, right? In other words, even though we've been investing in alternatives and we're excited about nuclear, it's not placing a dent in the world's demand for these fossil fuels. And he said, in spite of that, we have actually been decreasing our capital expenditures in recent decades in terms of exploration and development. And he said, look, even if demand were just a flat line from here, not even grow, he says, we're going to have some shortages in the not too distant future. I don't think you necessarily need to buy into uh, that theory to want to invest in oil and gas right now. But certainly, if Rick's true, if that proves to be true, that'll only add some pretty substantial tailwinds to this sector, correct?
Yeah, and Adam, there's so many places in the world that the only energy they have is combustible energy.
Hmm.
We forget about that in the U.S. That there's so many places in the world that's the only kind of energy they have. They don't have any other kind. And yeah, it'd be nice to have electric, but they don't even know what electric is in many cases.
I was
And
going to say,
so,
I mean, there's still, well over 1 billion people, maybe more, who don't have electricity or drinking water.
so yeah, you're right about that. I just think, you don't want to put the whole portfolio on energy, but it's just one of those things we think is undervalued right now.
Okay. Anything else that's on your, opportunity set of, hey, this is something that we particularly like right now that we haven't talked about yet?
Well, we have two different sets. When we talk about that 30, 30, 30, 10, that 30 that's in stocks is in a different look. And we've been buying companies, just a few names that we bought, for example, in the last couple of months that you wouldn't probably think about, or like Domino's, Gildan, if you own the t-shirt company that makes a lot of activewear, Mercado Libre, which is kind of the Amazon down in
Oh my
Uruguay.
goodness. Sorry to
Uh,
interject. That company was founded by one of my business school classmates, who I believe is a billionaire now.
well, probably is. But Autodesk, Bristol Myers, and those are in the stock side. Um, on the high income portfolios we run now, that's where we have a lot more energy, but also we have a lot of different other things. We own Vale, which is a Brazilian mining company, a lot of iron ore, other ores. Rio Tinto. No, these are all foreign companies, but they do great. You know, a great little fertilized LP that we own is CVR, and pays like a 12% cash flow,
Wow.
and that's a nice little LP. But they're different things we own over there. A lot of fertilizer we own, in copper we own different. That's where we have a lot of the commodities in that portfolio.
Okay. And in terms of portfolios at Oxbow, um, I'm painting with a very broad brush here, but as I recall, you kind of have three main portfolios that you're focused on. One is the growth portfolio, if we'll say, which is largely the equities that you were just talking about. And then you have two income portfolios, correct? One more conservative and then one more high income.
Right. The conservative portfolio is just for people that don't want to lose any money.
Hmm.
Uh, and so and there, you might not think this, but there's people out there like that, or they want a certain percentage like that. So they'll have more than one portfolio. The high income portfolio, though, is aggressive. I mean, we own things that pay a lot of cash flow, a lot of dividends, a lot of interest, and it's widespread. It's sort of worldwide. We own a lot of different things in there, but they create a lot of cash flow, and that's where we own a lot of the gold miners, gold, silver miners. All of that's in that high income account, and it's had a really good year this year. But we're running in that portfolio as good a year as it's had. We have about 55% still in short-term treasuries.
Wow. So even with that drag of just short-term treasuries, you're still having one of your best years.
One of the best, yeah. Our best years are always off market lows. That's where we have our best years, but
Right.
that's just because we have liquidity. We're not brainchilds or anything, but we have liquidity. So you can put liquidity in the market at the lows, and that's where you're going to get really, really big returns for a year or two.
Yeah. And your growth portfolio, the one that's much more just in equities, I recall the last time we talked, that was pretty healthfully in T-bills too. In other words, you weren't fully invested in that portfolio. Where are you now?
It's about 38, 40%, probably right at 40. And it's only running on a risk-adjusted basis. I mean, it's not running that far behind the S&P, but you have to think about it. Uh, it's a more conservative portfolio if I can have a really good return, but not have it all in the market. And so that's really where we come from on that portfolio.
Okay. So, uh, folks, just full transparency, I am a client at Oxbow, which is one of the reasons why I kind of know how the firm is structured there. And some of the things that I appreciate is the fact that the firm manages these three different portfolios. So, you can sample from all of them, right? You can say, okay, look, I want some of my money managed super conservatively. I want some of it to be getting income, and I want some of it to be striving for growth. So you have the ability there to kind of custom build your allocation. But I also like the fact, and this is me personally, you don't have to, your outlook probably shouldn't match mine. But I like the fact that even while they're striving to get the best returns they can, they are cognizant of the high degree of valuations in the markets. And so they have these cash reserves in the portfolios so that if and when there is a bear market, they've got the dry powder to then really lean in. And as Ted has said, the firm's best years historically have been the ones coming out of a bear market where you kind of have the blood on the streets. And it's the people who have capital to deploy when you've got those really cheap valuations are the ones who then really ride the recovery in the markets from then. So anyways, Ted, just underscoring why I'm a pleased customer.
Well, thank you.
All right.
I mean, everybody's the same. I mean, we don't really, all our portfolios are alike. If you choose one of them, you're going to look like everybody else. And it just depends on what you want, how you want to look at things. Everybody's different. We understand that. And generally, I think people today probably ought to take a look and say, how exposed do I want to be to the overall market? And we're seeing, I mentioned this before to you, but we're seeing more and more older people, 75 plus, 80, that have a lot of their money. I'm talking about 85 or 90% of their liquid assets that are in the stock market. And I just don't think they're thinking about the big picture when you're that age, and have that much exposed. But again, life's been good to them, so sometimes you can't make a case for them.
Well, it's sort of confirmation bias, right? You get
Yeah,
used to the way things have been, and then you say, well, of
right.
course they're always going to be this way. And this is what I think is the potentially nefarious trap of what you were talking about earlier, which is we're kind of a generation since the last market bear market. And so people have kind of just acclimated and said, you know what, I don't think the markets are as risky as they were. Even the ones who should know best, right? The older
Yeah,
investors, they've they kind of just think things have been different. Of course, every year the market goes up double digits, it reinforces that bias. And as I said earlier, we've had three great back-to-back years, right? So
yeah.
let me ask you this. So obviously, if you are near retirement or in retirement, I think you would say, Ted, hey, be cautious. Don't be all in stocks the way that some of these people that you're seeing, seem to be, right? So one, just be careful. But for someone say my age, who's in their 50s, um, I've definitely been more conservative than the average investor. And I've seen people who, in my opinion, who have been more reckless than me do better than me
Mhm.
because they're all in the Nvidias of the world or the meme stocks or whatever, right? And they're playing the game as it's, you know, is working right now. I mean, I can't really fault them. They're getting rewarded for playing the game that's delivering a winning hand. It's just to me too risky, right?
Yeah.
Um, and I talked about that K-shaped economy earlier, where the bottom, half is seeing the top half get further and further away from them. Um, might there be an opportunity here if we get the kind of corrective event that you think might happen, where there may be the potential for people who are kind of paying attention and being prudent to kind of change their station here positively, to kind of almost slingshot into the higher echelon, which is avoid getting big losses if and when the trades that have been doing so well stop working and then maybe go into reverse, maybe pretty substantially, and then also have that dry capital to then put into play when there are really good valuations to then ride what comes next. So you might be able to take yourself from kind of a middle of the pack player here to a front of the pack player if you play your cards right.
Well, no question about that. I mean, when you get, I think the hardest thing for an average investor, though, Adam, is determining when is it cheap? Okay.
Hmm.
It comes off 15%, and they go, gosh, I ought to make a good buy. but it's like it was like for us in 2008, the market went from the Dow went from 14,700 to 8,800, big sell-off by the time we got to October. And then, believe it or not, and we put some money in. It ended up being great to put it in then, but we kept a lot of money back. And by the time you got to March, the first week in March of '09, we went down another 25%. We went to 6,600. And those are the points I'm talking about with people. I don't think the average investor is real good at knowing how to scale in and out.
Mm-hmm.
They're like all or nothing. And
Yeah.
that's a tough way to run the business. You have to know when to scale in and scale out. If you have a huge winner that's gone up 15 times, 20 times, sell some of it. Take your cost out, take some profit out. You never know what the future is going to hold. And the same on the downside, you buy a little bit, it goes lower, you buy some more, but you're looking at a longer period of time. And I think the average investor, it just doesn't know much about scaling.
Well, this is one of the reasons why I recommend so strongly that most people work with a professional financial advisor because one, it sort of takes the emotional decision making out of your hands, and then you're also leveraging the expertise and the experience and the level head of the professional. Um, I also imagine if we do get this big corrective event in the markets, from what you've told me in the past, Ted, when it's the right time to buy, it's going to feel terrible to do so,
Oh,
right?
yeah.
This is when nobody wants to touch a stock and it feels like you're just throwing good money after bad and all that stuff. So you really have to have some sort of either framework or guide who is going to start guiding you on the scaling in then.
Yeah, for us, we just, we look at the single company, and
Hmm.
it may be so cheap, it's incredible. Not that it couldn't get cheaper, but if I could make a case to somebody, if you own this whole company, and it's real cheap now, and you own the whole company, you would buy this whole thing and just own it as your company because it will do that well over the next 10 or 15 or 20 years. And that's how you have to look at it on the lows. You have to decide, would I buy the whole company to really get aggressive? And that's really sort of the way we look at it. And it's the same way on the highs. If we get stocks that are so expensive, would we ever even think about owning this whole company? No. And so then you sell some. So it's on both ends really.
Okay. Well, Ted, look, this has been, as usual, a fantastic discussion. We're coming up on the hour here. I do want to spend a few minutes talking about the free webinar that your firm is offering next week on succession. So, I mean, we're going to get into the weeds of it in the webinar itself, but can you just talk for a minute or two about the importance of it? I mean, you, again, have spent a long career advising people. Your firm specializes in high net worth clients, especially entrepreneurs who have had a nice liquidity event after selling their life's work. Um, you've seen firsthand, the person who has worked so hard to build the family wealth, uh, but then need to say, look, I'm not going to be around forever. So how do I make sure that all this gets managed the way I want it to if I'm not around anymore? And I'm sure you've seen the good and the bad, people who have planned well versus people who haven't planned well. So why is this such an important topic?
Well, I think the biggest thing with it is you don't know what your future holds. And so, from an age standpoint, there are going to be things that you didn't expect. We get this every year, we get a few of these where one spouse or the other did all the investing, but all of a sudden they have Parkinson or a stroke or they're an invalid, they can't do it anymore. And then the spouse that's remaining uh, really has no idea. Now they don't even know who to trust. That's another. See, I mean, so you have to spend a lot of time with them just so they understand, hey, you can trust us to do the right thing. But see, that should have already been in place. You didn't have, I mean, we're not trying to take the car keys away from you. All right. I mean, well, my point is you don't have to do the whole thing, but you need somewhere along the way to have a relationship with people so that and you may just get to the point, we've had people do this and say, I'm tired of it. I don't want to look at it every day. I'm going to enjoy life. I want to travel.
Oh,
Let's
spend time
stop
with my
here.
grandkids. Yeah.
I'll tell you something else, and I'll mention this before, but now when you call, we have a lot of custodians, and I don't talk to them myself, but I know what goes on. And if you call, the Fidelities and Schwabs and the Vanguards of the world, all the big custodians, and you get somebody on the phone, about, a lot of them are just lost. So they lose you too. I mean, what I mean is you don't know you're trying to get something done, but you don't have the capability to do it. And that's when you got to start thinking about, okay, I could use somebody to really help me here a little bit. And again, you don't have to give them the whole thing. I understand there's an ego thing in there, but it's certainly something to think about.
Yeah, there's an ego thing of not wanting to give over the reins. There's also sort of a, you know, humans don't like to think about their own mortality. So it's one of these things,
Yeah.
wow, I don't want to think about it now. Maybe we'll do it later. And then, of course, potentially it becomes too late. And I think this is such an important topic for this audience here at Thoughtful Money, because I know from the surveys I do to this viewing audience that like 75%, 80% of these viewers consider themselves DIY investors, right?
Mhm.
So they're doing it on their own, right? So, that's great. But, at some point, you're not going to be able to continue to do it. And so, to Ted's point there, you don't have to give over the reins today, but just like having a will and a trust is a prudent thing to do and an act of love to do in advance for your loved ones, figuring out who the baton is going to go to before you actually have to give it up is prudent in a similar act of love. And if it's somebody in your family, fantastic. And if they need a couple years of grooming time, of you educating them and getting them up to speed, fine, great. Just start that process now. But if it's not, and there are a lot of people I talk to who they say, no, there's, my spouse certainly doesn't want to, my kids aren't interested, or I just don't think they have the experience, I don't trust them enough to get good enough at this, then at least right now work on identifying who your successor will be. And if it's a firm, doesn't have to be a firm like well, it doesn't have to be Oxbow, but I would say make it a firm as good, if not better, if you can find a better one. And I think that's a tall order, but if you can, great, that's fantastic. And get that in place. And hopefully you don't need to pass that baton for, many years, decades, hopefully. But, just in case things happen faster than you think, at least you've got that plan B already set up. So
Yeah.
if you are interested in attending this, I think, very important conversation with Ted and the Oxbow team, again, just go to thoughtfulmoney.com/succession, and you can sign up for free. And again, the actual event itself will be this coming Monday, the December 15th at 7 p.m. ET. And if you are watching this video after the webinar takes place, just go to that same URL and it'll redirect you to the replay video. Ted, as we start to wrap up here, I guess last main question for you, is there anything else that's burning brightly on your radar about the markets, the economy, whatever, what you're hearing from clients that I just haven't been intelligent enough to think to ask you?
No, not really. I mean, I think and that complacency meter is really, really high. I mean, people are very complacent right now, and they just don't. They're not worried about it. And that goes back to that do-it-yourselfers. Things have been good so long that why would you ever use anybody else? So it all goes together. When you go a long period of time and nothing bad happens, then that's sort of what you end up with. But I think people need to really stop and think about history here. Go read a few books, and then you'll change your mind.
All right. Well, very well said. Well, folks, two things. Please show your appreciation for Ted coming on and giving us so much of his time and expertise by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And you hear me say at the end of every one of these videos that if you want some professional help and you don't already have a good professional financial advisor who is advising you, that you should talk to one of the ones that this channel endorses. I highly recommend that. But if you want to talk to Ted directly in his firm there at Oxbow Advisors, there's a form to do that. Just go to thoughtfulmoney.com/Oxbow, fill out the very short form there, and the team at Oxbow will be in touch with you right away. I should manage expectations though, Ted. Your firm does have some minimums because you tend to deal with higher net worth clients. What minimum should we tell folks you've got here?
Well, and it's not that we wouldn't, people that don't have the minimum, we always keep them on an email list and try to help them as much as we can. We're just not going to be able to manage for them. But, you're looking at, typically, typically out of state, we need $4 to $5 million to manage that account. In state, not quite as much, but our average account size is going to be that size or higher. And we manage a lot of money that's higher than that as well. But we usually have 4 or 5 people on an account, so it's not that we're arrogant or anything like that. It's just that you have to look at the economics of it all, and that's where that comes from.
Okay. All right. Well, look, and when you say in-state, you mean Texas, correct?
Yeah.
Okay, great. So, folks, anyways, if you meet the criteria or you just like to talk to the team there at Oxbow, again, go to thoughtfulmoney.com/Oxbow. If you don't have enough to meet their minimum, but you'd still like to talk to one of Thoughtful Money's endorsed financial advisors, you can fill out the general form at just thoughtfulmoney.com, and you'll be connected with one of the other advisors there. Ted, thanks so much again, folks. Hopefully, we see you at the free webinar next week. And again, folks, to sign up for that again is thoughtfulmoney.com/succession. Ted, I can't thank you enough. You're such a gentleman.
Thanks a lot, Adam. Good to visit with you again.
All right. You too, my friend. Hope to see you in person at some point in 2026. Everybody else, thanks so much for watching.
We're moving into a new digital system. I believe that this will now usher in the hyperinflation to burn off the debt that's being created. So we'll have Amazon stable coins and Walmart stable coins and Kmart stable coins and, JC Penney, as well as JP Morgan, as well as Hong Kong stable coins, the yuan stable coins. So it is an extraordinarily fragmented market, but they are thinking that within the next 2.5 years, by 2028, they will go from about 125 billion stable coins to $2 trillion in stable coins.
Stablecoin adoption is accelerating, with issuance doubling to $250 billion from $120 billion. Offering a more tempered outlook, JP Morgan estimates the market may reach $500 billion by 2028. Meanwhile, forecasts suggest the market could grow to $400 billion by year-end and $2 trillion by 2028, citing limited mainstream adoption and regulatory challenges. Yet, only 6% of usage is tied to real-world payments, while most remains in trading and DeFi. The Genius Act is shaping regulatory clarity, boosting institutional interest as major players like JP Morgan, Amazon, and Walmart explore stablecoin models. Analysts see them becoming core payment infrastructure, bridging fiat and digital money in a hybrid financial system. The speaker, Lynette, the chief market analyst at IDM Trading, argues that silver and gold are massively undervalued compared to their true historical ratios and fundamental worth. Based on a traditional 20-to-1 gold to silver ratio, silver could be valued between $1,300 and $2,000 per ounce, while gold's fair value could range from $33,000 to $40,000. Current spot prices are seen as artificially suppressed by paper derivatives, but since both metals are sound money, they cannot be inflated away like fiat currencies. In times of crisis, gold and silver act as a bridge, preserving purchasing power as overvalued fiat-based assets, and real estate collapse, enabling wealth transfer to those holding real money. Looking ahead, Lynette warns of inevitable hyperinflation as currencies lose credibility. In such scenarios, governments historically revalue gold to restore public trust, often after lopping zeros off collapsing currencies. While gold and silver prices would soar during hyperinflation, gold has historically held elevated value longer than other assets before being adjusted, only to climb again under the new system. This pattern, repeated throughout history, is expected to play out again. As we present clips from the video, firstly, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
what happened in 1980 at that $50 mark. I consider this a massive double cup because it did come up to breach that level. And so when it goes above that 50, would 3 or even 4 digits in the silver nominal price, the price that we see, would that be outrageous? No, it's worth at a minimum $1,300 an ounce. And that's just based on the 20th to 1 that historically these were both, well, it's peace dollar. Okay. These are both $1, little $1 gold coin and a silver dollar. So that's a 20 to 1 ratio right there. So according to my calculations, you're looking at the true fundamental value of an ounce of gold at somewhere between $33,000 and $40,000 an ounce. So at $3,400, spot gold is a ridiculous bargain. But that also then means that silver's fundamental value at this moment is somewhere between $1,300 and $2,000. And remember, the more of this that they do, the higher those numbers go, because this is fiat money, government debt-based money. But gold and silver are sound money. Sound money is money that governments and central banks cannot inflate away. They can manipulate what you see through the use of garbage derivatives, but they cannot inflate it away. The point is they are both money. They're just the opposite sides of that money coin. And as this loses more and more and more of its purchasing power value, these go up in nominal terms. But what they really do is they create a bridge, because when one currency goes away, another one comes in. It's just that you need something and I need something. We need something that will hold its purchasing power intact to get us from one system into the next system. And dare I say it, even have the ability to take advantage of the opportunities that will present as these extremely severely overvalued fiat money assets. And real estate is actually not pure fiat money because it is a tangible as well, but it's severely overvalued. That's going to flip-flop. So if you can hold your purchasing power intact, you're going to be able to have that wealth transfer your way. Well, I personally do not see it. I see it as inevitable, because what gold really does is it regains confidence. I mean, they want us to think that gold is an old relic, except wedding rings are generally in gold. Good as gold. It's in our vernacular. It's in our DNA. And it's used to regain public confidence after that massive failure, which I believe we are like this close to experiencing, and the hyperinflation. But make no mistake, every single country has a gold revaluation account. They're not going to do it at these levels because it does not reflect all the paper money that's been issued. So what I think we will see, and it's just a repetition of history, because this has happened over 4,800 times. I don't think this time is any different. And that's really what the point is. But they have to, you have to kind of back up to move forward. If they did it now at the artificial level that the spot markets are, then it wouldn't have as great an impact if they wait until they finish blowing up the currency in a bout of massive hyperinflation. And what they do then is, of course, they lop off zeros so people think, well, they've got this under control. So you've got a loaf of bread. And I know this sounds outrageous, but it's not outrageous. It is just a repetition of history, where a loaf of bread might go for, as it enters hyperinflation, a loaf of bread might go for $80,000 a loaf, right? But then what happens? They lop off 3 zeros or 4 zeros as they do that overnight revaluation. And so it goes from $80,000 a loaf to $8 a loaf. But so do your savings, and so do anything that you've accumulated in fiat. And frankly, so will the nominal price of gold. First, it'll go up massively, right, in the hyperinflation. But the difference between, say, your stocks and everything else, that drops dramatically immediately upon the revaluation. Whereas gold, it's on average, so I can't guarantee this, but on average will stay up at that level for about 9 months before it too gets revalued, but then it instantly begins to climb again in terms of that new currency. So that is what I anticipate seeing. I don't anticipate seeing it before we do hyperinflation, because there is not yet the need to regain that public confidence. But I watch that like a hawk, because that, my friend, is the only thing that's keeping all of this stuff together.
The $50 silver level from 1980 remains important because it highlights how heavily manipulated these markets are. Just as gold and silver were once taken from the public and openly admitted to be manipulated by governments, today's spot prices don't reflect true price discovery, with LBMA inventories dropping sharply before partially recovering, while silver holdings remain much lower. This underscores silver's dual role as both an industrial and monetary metal, making it more vulnerable to hidden maneuvers. ETFs like SLV also expose this manipulation. Their structure was altered so they no longer need to back shares with actual silver. That leaves ordinary investors holding paper claims, while powerful players like JP Morgan or Saudi Arabia could still take delivery of the physical metal. This setup creates a backdoor way for institutions to control silver supplies, while the risks and losses are pushed onto the public, who falsely believe they own real silver through these trusts. Let's shift our attention towards the interview.
Yes, I definitely do think that triple digit price. Now, one thing that you mentioned about 80s with the Hunt brothers accumulating silver, because they wanted to leave the US and form their own little country in Texas. However, the importance of that should not be just trivialized or ignored, because what we were really dealing with was an overt manipulation by our government of the silver markets. And everybody was warned. And I have to say, Jesse, I have often wondered when these things that happened, and they seem outrageous to me, like taking the gold away from the population, like taking the silver away from the population, like a sitting president admitting that they're going to manipulate the markets. And I used to wonder how they could get away with that, why people didn't rise up and say, no, you can't do that. That's crazy. Well, I think we're living through that right now. And I'm seeing it happen. I think there's a lot of blindness that's going on. So I do actually consider the $50 mark nominal, to your point, to a very valid point, because these markets are manipulated. They are admittedly manipulated. And so if anybody really expects there to be any level of good price discovery with spot gold or spot silver, and I always make sure I say spot, because that is just a contract. And when you're talking about silver, there's a chart from the LBMA that they came up, and of course we know that there was a huge rush of physical coming into America at the beginning of this year. And you can see the stores in the LBMA dropping in gold, dropping and then rising again and coming back pretty close to the levels that they had before whatever came out of the LBMA. I'm actually more interested in what came out of the BOE, but let's just stay with the LBMA for a minute, because the same kind of issue with the physical metal being shipped over happened with silver as well, but their stores are significantly lower than they were before that physical push into the US. So what does that tell you? It tells you that silver gets used up in industry And just like the SLV silver ETF that is supposed to be a basket of silver, they couldn't put the basket together. So back in, I don't remember whether it was 21 or 20, but they changed the prospectus. SLV changed its prospectus so that they didn't actually have to pull a basket of silver in, but rather all they had to do, which is what they were designed to do anyway, which is imitate the spot silver market. I think we could see that because silver is the secondary monetary metal, but it is rather, I'm pretty sure that Saudi Arabia would be considered an administrator, which means that they would, you and I can't do it, but they would have the ability to take possession of the underlying silver. So I think that that is a manipulation to make that happen, because that can happen even more invisibly than what we were just talking about. And since silver is used across every single sector of the global economy, in solar, in medicine, et cetera, and gold is as well. Both of them are, but silver more so straddles that world. I think that this could also be a maneuver to ensure that they get their hands on the physical silver. At the end of the day, the holders of SLV won't. I mean, the normal holders of SLV wouldn't, but JP Morgan would and Saudi Arabia would. So I think it's a backdoor way to do it and have control of it. But the real problem is it would have to be done strategically. Like I'd be curious to see how much of a percentage of the holdings that they already have in silver that would actually represent. Because if they did take out the physical at the same time that SLV itself, that trust, is selling off bits of silver on a daily basis to pay the rest of the fees, the repercussions for the public would be huge. Those that think that they actually own silver with an SLV, they just own shares in a trust. But that could have some really significant significant impact on the risk transfer to the public.
The rise of digital currencies, the undervaluation of gold and silver, and the ongoing manipulation of precious metal markets all point to a fragile and shifting financial system. As fiat currencies weaken and hyperinflation risks grow, physical gold and silver remain the most reliable anchors of purchasing power, offering protection and opportunity during systemic transition. The real question is not if, but when this reset will force the world to rediscover the value of sound money. Do you think central banks will allow the public to benefit from gold and silver's true revaluation? How should ordinary investors prepare for a financial reset driven by digital money and precious metals? Please share your thoughts in the space provided for comments below. Please remember to subscribe to stay updated and to give this material a thumbs up if you found it helpful. We appreciate you coming along on the ride.
The point is, we're seeing lots of silver that is being accumulated by the central banks. That's $2,225,790,000 worth of silver has come into COMEX. In the first week or so of the month, Russia, China, Saudi Arabia, let's not forget about India, who's bought somewhere between 600 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. Most of the public has zero idea that there is a massive drive going on for gold and for silver. First week of September, you're seeing nearly $4 billion worth of metal stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend.
Central banks are quietly stockpiling huge amounts of silver, with Russia, China, Saudi Arabia, and India leading the charge. Saudi Arabia has made small but notable purchases of silver via ETFs recently, which may signal a shift in behavior. China has bought 21 metric tons of gold so far this year, 2025. It's part of their strategy to diversify away from the dollar and align reserve assets with their global status. The notion that BRICS and other developing nations are considering silver more seriously due to its dual uses is being more widely reported. India alone has accumulated 600 to 800 million ounces in the last 5 years, more than what COMEX and LBMA hold combined. The US, traditionally an importer of silver but never of gold, is now importing both, a clear sign of a much larger global trend toward physical accumulation of precious metals. Andy, the president and CEO of Miles Franklin Precious Metals, highlights that what makes today's market different is the sheer scale of physical gold and silver being accumulated, not just by investors but by central banks, with Russia allocating it in its 2025 to 2027 budget and Saudi Arabia making ETF purchases. COMEX deliveries of gold and silver remain historically high, signaling strong demand for physical metal, while a weaker US dollar is further boosting gold and drawing silver into reserve diversification strategies. Analysts like Mike Maloney see silver poised for significant upside in a potential monetary reset, though claims of India's massive silver accumulation and extreme delivery spikes remain unverified. Experts also warn that paper metals may not provide true protection in a crisis, driving the push toward physical holdings. Andy believes the public, meanwhile, remains largely unaware of this massive shift toward physical metals. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, I think that what differentiates this market from anything I've ever seen, Ivan, and I've been doing this now for almost 36 years, is the amount of physical demand that is being accumulated. Now, we've talked at length about the central banks that have been buying gold. We're seeing action with the central banks buying silver. Now, of course, it started with Russia saying they were going to add it to their stockpile. First time I've ever seen a government do that. And then it mitigated moved towards China. Talking to guys like Sean Kuhn from Dolly Varden, he says, look, Andy, the Chinese, who are the second largest producer in the world, they told David Morgan they're the first, by the way, but needless to say, they're massive producers. Sean says they're flying all around Latin America, in particular places like Peru, even all the way up to Mexico, and pulling metal out of the ground before it's even called silver. They're buying doré, they're buying concentrate. They're paying double what the West will do to disintermediate the whole market, sending it back to China for refining. So you have the first or second largest producer in the world finds it significant enough to fly around the world and buy doré and concentrate right out of the ground from the miners, directly from the miners, and then sending it back to do so under the cover of anonymity, so to speak. No one really knows how much they're buying or what they're getting, but Sean can validate that is indeed what is happening. You look at the Central Bank of Saudi Arabia. Disappointing as it may be that they bought huge amounts of SLV, maybe one of the worst products I've ever seen ever in my career, because just as a side note, the short position right now in SLV is 53.97 million shares,
wow.
Which is it's grotesque, it's ridiculous. And remember what the prospectus said, BlackRock said, there could come a time when there's not enough silver to cover those short positions, buyer beware. But the point is, we're seeing lots of silver that is being accumulated by the central banks. What is really different to me, as far as I'm concerned, is the amount of silver that is coming into the COMEX. And, last week I jotted down some numbers. In month to date, in September, the number of contracts, and this was last week, I'm sure it's much more now, that stood for delivery was 10,599 contracts. Let's do the math real quick. 10,599 contracts times each contract weight being 5,000 ounces is 52,995,000 ounces. We'll multiply that, let's just call it by 42. That's $2,225,790,000 worth of silver has come into COMEX in the first week or so of the month. And this is what we've seen over and over and over again. The point I want to get across here is that when you have countries, Russia, China, Saudi Arabia, let's not forget about India, who's bought somewhere between 600 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. And now you see it happening in the United States. At this level, the people don't just have the most money that are standing for delivery. Now, when we say stand for delivery, mind you, this is going into COMEX. A lot of it leaves. A lot of it doesn't leave. So regardless if it's leaving COMEX or being put into an eligible account, not registered, meaning it's not available for sale, it's going into strong hands. To this degree, these people are not only the most well-funded traders on the planet, i.e. the central banks, the commercial banks, the very sophisticated traders that can stand for delivery on COMEX to the tune of billions of dollars every month since November, since the election, but they're also the most well-informed. And I think that's the most important thing to understand, is that the people at this level who swim in circles of 9-figure monthly acquisitions are not doing things just for kicks. They're doing it because they understand where we are going. They know the playbook. They are at the highest level of information. And that's what I take away from really where we're at this moment, is that price is relevant, but price is a tool of misdirection, allowing the big money to position before all of the people that you and I call friends outside of what we do for a living talking about this stuff. The people who may be very smart, very bright, very well read, arguably just reading the wrong shit. And that's the problem. So most of the public has zero idea that there is a massive drive going on for gold and for silver in terms of delivery. Just as a side note, in the first 5 days or so, 6 days of the September contract, which is a non-delivery month, 3,626 gold contracts and 100 ounces apiece stood for delivery. So you're talking $1.5 billion there too.
Wow.
So in just the first week of September, you're seeing nearly $4 billion worth of metal stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend, and that is that the smartest money in the world understands that there is a rush for physical acquisition of metal, bypassing the paper promises. So there you go. Crazy times, brother, and I think we're just beginning in silver.
Andy points out that central banks and BRICS sovereigns Russia, China, India, and Saudi Arabia are accelerating gold and silver accumulation, often buying ore and concentrates directly from miners, while the West relies more on paper vehicles like SLV. Russia confirmed BRICS talks on a new precious metals exchange with its own pricing, clearing, and auditing, reducing reliance on the Western system, while silver is gaining traction as a reserve asset, with reports of Russian buying and Saudi Arabia making first ETF-linked silver purchases. Analysts warn Western price suppression looks increasingly like misdirection, with BRICS building parallel commodity infrastructure to secure physical supply. Experts predict gold will remain strong, and silver could see outsized upside given its smaller market, though volatility and delivery bottlenecks may increase.
The only saving grace is, and maybe I would like to think they're not misinformed. See, if you and I bought SLV, we can never take possession. They can, because it's the amount that they purchased. You have to have a certain amount, and it's called a basket. If you are able to redeem a basket, which I don't know the exact amount, 20, 30, 40, $50 million worth, they can. So I'll give you an example. Kyle Bass, when he was running the fund for the Texas Teachers Union years ago, they bought, if I'm not mistaken, $1 billion worth of GLD. They stood for delivery. Saudi Arabia can do the same thing here. They do have the right to stand for delivery, and most of that metal, if I'm not mistaken, is held in the LBMA. So because they bought such a significant amount, they can stand for delivery. And maybe they had a reason behind doing that I'm not sure. For you and I, buying SLV is as dumb as a mud wall. Not only do you pay the capital gains for collectibles when you sell it, you can never take possession. It's custodied by JP Morgan and BlackRock. Of course, JP Morgan, as we have identified multiple times, paid the largest fine that the Justice Department had ever handed out at that point, $920 million or so, for manipulating the silver market. Well, and that was kind of, and the reason that I think that they got off so easily, I believe that this was done at the behest of the central bank, who gave them the green light to do this. And there are bigger reasons at play for holding down the monetary metals, but that's for another discussion. Simply to say, it was far more. In fact, you could argue that it was far, far, far more than just spooking. It was manipulation, and it was at one point thought it would be RICO charges, because in essence it's, like the hitman kills someone, well, they can go after the mob boss because the mob boss ordered it. Well, the point of it is that who up the chain of JP Morgan understood this? Is it just the head trader, Michael Nowak, who was the sacrificial lamb that was put in jail for a couple of years? Or, I don't know. The point of it is that this is something that you can only manipulate a market, Ivan, for an extended period of time by pushing it in the direction that it is going. And I've been doing this for almost 36 years. Most of the time, the world didn't want gold and silver. They wanted U.S. bonds and U.S. stocks and real estate. They wanted what was, when things got scary, there was a rush to the dollar. What is happening now is that the big money around the world has become motivated, coordinated, and sophisticated, and they understand what's happening. The big money around the world largely being, when I say that, I'm talking the BRICS countries, in particular Russia, China, now Saudi Arabia, India. All of these countries understand, and they have been using the spoofing or the manipulation or the suppression of the metals market against us. In other words, hold the paper price down in the West, and then go all around the world and drain the supplies, especially off of exchanges around the globe that don't affect the price. The price is set in the West, so if you smash the price down on paper here and then buy it up there, and there, boy, that works out well. And they're smart enough to see the big picture. That's what they're doing. And then they go as far, and just ask yourself, the second largest producer of silver in the world, the largest producer of gold, don't sell an ounce. They fly all over the world and buy gold and silver in doré, which is a crudely refined bar, in concentrate, which is a byproduct of it, right from the miners, which completely disintermediates the amount and disintermediates the market and the commercial banks. They're thinking 2 or 3 steps ahead. They're playing 3D chess, we're playing checkers. So I think that this is something that is being used against us without saying so. They get it. I'll evidence it this way. I've spent a lot of time talking about the BRICS, and the BRICS grain exchange is something that is under development. And I listened to an interview about the guy who's running it a year ago, and he said, we here in the BRICS produce and consume in the global south more wheat than they do in the West. Yet we have no control over its price because that is controlled on COMEX. But with the development of the BRICS grain exchange, that will change. Now,
Wow.
They understand what we're doing with the precious metals, with the base metals. All of the things that we have suppressed for various reasons are now being used against us. It's jiu-jitsu, the premise being you use your opponent's leverage against them. And this is exactly what's happening right now, man.
Will central banks' increasing use of silver lead to a structural revaluation to that of gold? What potential effects may the establishment of a BRICS precious metals exchange have on shifting global pricing power and diminishing the importance of Western markets? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
And the price of gold has, it's more than doubled, actually tripled in the last couple of years. So the thing with gold, just in U.S. dollars, going from say $1,500 per ounce to $3,500 per ounce, which was the recent all-time high. What really happened is the dollar has gone down significantly relative to gold. It's a weakening of the dollar. Now, the dollar has performed much better against other currencies. Recently, very recently, last 4 or 5 months, the dollar has gone down, the major indices, but that was from a fairly high level. It actually got quite strong against all the other major currencies. So I expect the dollar to get weaker against other major currencies. But if you're talking about gold, I would expect the opposite, that the price of gold would go up, which means that all the other currencies are falling even faster. So I would expect the Aussie dollar to get stronger relative to the US dollar. I do expect it to go higher. There's no way that gold is going to double or triple, and silver won't be along for the ride. So you can see $100 silver at some point and even higher from there.
Gold has jumped from $1,500 to $3,500 an ounce in just a few years, not because gold changed, but because the US dollar lost value against it. Though the dollar recently strengthened against other currencies, it's expected to weaken further, with all major currencies losing purchasing power even faster. JP Morgan notes that central banks are accelerating de-dollarization, cutting dollar reserves and boosting gold holdings, with the dollar's share of global FX reserves now below 60%, its lowest in 20 years. Meanwhile, silver is likely to follow gold's rise, potentially hitting $100 or more per ounce. Jim Rickards, an American lawyer, economist, and investment banker turned financial commentator, mentions the U.S. is deliberately pursuing a weaker dollar under what's being called a Mar-a-Lago Accord, tying tariffs, trade policy, and even military protection to currency values. Morgan and Reuters highlight expectations of a weaker U.S. dollar ahead. Asset management models suggest the dollar is overvalued by 10 to 20% against currencies like the euro and yen. At the same time, a softer dollar through 2025 is seen supporting emerging markets, attracting investors toward higher-yielding assets outside the U.S. However, Jim Rickards predicts the U.S. will devalue the dollar, but partners must not devalue their currencies in response. As a result, currencies like the Aussie dollar, sterling, and Swiss franc are expected to strengthen because the U.S. is actively forcing it. To ensure you don't miss any updates, don't forget to hit the bell symbol and subscribe as soon as the video starts. If you like the content, please let us know by leaving a comment below.
I would expect the Aussie dollar to get stronger relative to the US dollar. But there's a very specific reason for that. There's a lot of buzz around the world of, the BRICS are coming up with an alternative currency, and people are getting out of US treasuries and losing confidence in the US dollar. US budget deficits are out of control. The US debt is out of control, et cetera. And none of that is basically true. These are talking points, but they have to be put in a context. The U.S. debt, $37 trillion, that's a big number, for sure. But you can't think about debt without comparing it to the resources. What is the GDP behind the debt? What are the assets on the other side of the balance sheet? And those kinds of things the Trump administration is talking about. And so one of the most influential advisors in the White House right now is Stephen Moran. He's an economist, but he wrote a paper last November on basically reconfiguring the entire global trading system. Pretty big claim. In there, he calls for something called the Mar-a-Lago Accord. And by the way, that was the title of Chapter 6 of my book, Aftermath, which came out in 2019, last time I was in Australia. So I'll take credit for coming up with the name. But his version of the Mar-a-Lago Accord looks at tariffs, trade, and exchange rate values, and kind of getting to your question, Jordan, about the Aussie dollar. Now, let's say I put 20% tariff on it. I'm the United States, and I put a 20% tariff on a trading partner. So some goods are, let's just say 100, it could be 100 million or whatever, but 100 as a measure, and I throw a 20% tariff on it. Now it's 120. But what if the trading partner devalues its currency by 15%? So it was at par, let's say hypothetically, and you drop it from 100 to 100 down to 85 to 100. Well, that negates the impact of the tariff, because yes, the tariff marks up the price, but if you're the producer and you can lower your local currency costs, your labor costs and so forth by devaluing your currency, you dilute the impact of the tariff. So what he is saying, and indirectly what the White House is saying to U.S. trading partners, is we're going to put these tariffs on, so that's a given, but don't you dare devalue your currency. Sure. We're going to devalue the dollar. And any trading partner that tries to offset the tariffs by devaluing its currencies, there are going to be consequences to that. And he uses what I call the traffic light system. He says red, yellow, green in the U.S. That's traffic light. But he said we're going to divide U.S. trading partners into three categories. So green, you're a friend, you work with us, we've negotiated the tariffs, you accept the tariffs, and you accept the fact that we're going to devalue the dollar. Yellow, you're okay, you're not an enemy, but you're not our best friend, and you may suffer higher tariffs. Red, you're an adversary, clearly China and Russia. I think it's a mistake with Russia, but China and Russia would be in that category. You're going to get tariffs, if not sanctions, etc. But in addition, this is where it gets tricky. He injects national security considerations. It's like, wait a second, this guy's an economic advisor, maybe a Fed governor, but what's he doing talking about national security? Sounds like Henry Kissinger. But he said, if you're in the green category, you will get the benefit of U.S. military protection. Sure. You'll get the nuclear umbrella and more. If you're yellow, we may work with you. And if you're red, you can expect that we'll be in an adversarial position. So the significance of that is he's putting military might and security guarantees behind his claims about the U.S. dollar and exchange rates. Now, that's only been done twice in U.S. history. One was between 1971 and 1974 when Richard Nixon closed the gold window. It suspended the ability of foreign trading partners to redeem dollars for gold. The second time this was done, where the goal was to devalue the dollar, was 1985. James Baker was Secretary of the Treasury. Ronald Reagan was president. But this Baker really took the lead on this. And using some of these indices I mentioned, the dollar was at an all-time high, and Baker said, no, it's not good enough. We have to devalue the dollar. So the dollar dropped about between 15 and 20%, depending on the cross rate at the time. So here's the third instance of the U.S. engineering a devalued dollar. This isn't the markets doing this. This is the U.S. Treasury insisting on it. So I look at the Aussie dollar, sterling, Swiss francs, euro, and say, you're all going to get stronger because the U.S. wants that. The U.S. is forcing that to happen and backing it up with some pretty nice rewards, carrots on the one hand, but a stick if not.
Jim Rickards recalls that since 2010, central banks have shifted from being net sellers to consistent buyers of gold, led by Russia, China, and others steadily accumulating reserves. China, Russia, Turkey, and India have led global central bank gold buying in recent years. China resumed reporting reserve increases in 2022 to 23, adding over 150 tons in early 2023. Russia keeps buying domestic gold while cutting U.S. treasuries. Turkey continues heavy purchases despite economic strains. And India steadily grows reserves while reducing dollar reliance. Eastern European banks like those in Poland, Hungary, and the Czech Republic have also accelerated gold accumulation. Overall, BRICS nations now account for the bulk of central bank demand, far outpacing Western buyers. In addition to this, central banks now hold 36,000 tons of gold, surpassing their treasury holdings in value for the first time since 1996, valued at approximately $4.5 trillion versus $3.5 trillion in treasuries. For the last 3 consecutive years, central banks have purchased over 1,000 metric tons of gold annually, roughly double the pace seen in the preceding decade. A World Gold Council survey shows 76% of central banks plan to increase gold holdings over the next 5 years, while nearly 75% expect to reduce exposure to U.S. dollar assets, a sign of accelerating de-dollarization. Jim believes this central bank buying creates a price floor for gold while leaving unlimited upside, making it a strong long-term play. Now let's delve into the interview.
Well, you're exactly right, Jordan, about the central bank buying, and the turning point, you can actually chart this, was 2010, but right after the global financial crisis of 2008. From 1970 to 2010, central banks and finance ministries, sovereign wealth funds were net sellers of gold every single year. Beginning in 2010, central banks collectively became net buyers of gold. Russia has tripled, more than tripled its gold reserves from about 600 metric tons to almost 3,000 metric tons. I guess it's gone up closer to 5 times. Same thing with China, from about 600 metric tons to 3,000 metric tons. But we've also seen Japan go from 600 to 900 metric tons, etc., Kazakhstan, Vietnam, Philippines, Mexico, Turkey, Iran. Iran's not transparent, but they've been buying gold, etc. So you have this fairly large group of central banks who are buying gold. Where are the sellers going? So between 1970 and 1980, the U.S. sold 1,000 tons. We went from 9,000 metric tons to about 8,100, just a little over 8,000 metric tons. But the U.S. stopped cold. We never sold any gold after 1980. And there are reasons for that. Probably don't have time to go into them. They're highly technical. But so the U.S. has stopped selling gold. We're no longer a seller. We've just stopped at 8,133 metric tons. So the sellers went away. The buyers continued. They will continue going forward. And what's interesting from a gold investor's point of view, central banks and finance ministries are actually very smart buyers. They don't chase the market up. They buy the dips. I hate to use cliches, but they buy the dips. They put in just steady orders. They're not out to buy, the whole everything they need at once. It'll be 20 tons a month, which Russia did. Central Bank of Russia was very transparent. By the way, just as a quick aside, Elvira Nabiullina is the head of the Central Bank of Russia. In my view, she's the only central banker in the world who actually understands her job. But she put 25% of Russia's reserves in physical gold stored in Russia between 2010 and 2022, which was the beginning of the war in Ukraine. So what did the U.S. do? Well, the U.S. and Europe froze $300 billion worth of U.S. Treasury securities that Russia had bought lawfully. They shipped oil, got dollars, bought Treasury securities, trusted the United States, which was, hindsight, turned out to be a mistake. So there are about 200 billion of Treasury security, Russian-owned Treasury securities in Euroclear. That's all been frozen. And the U.S. does it all the time. We're good at freezing things. But now they're stealing it. They're actually seizing it and using it and the interest on it as collateral for loans to Ukraine so that Ukraine can buy weapons to fight Russia. So Russia's own money is being used to fight Russia via Ukraine. But why hasn't Russia crumbled? Well, the answer is they had $150 billion in gold that the U.S. can't touch, can't freeze, can't seize. And that's one of the nice things about gold. It's not digital. I can't hack it. It's just there. You are there unless you want to invade Russia, which is a whole different thing. And one of the ironies is when the U.S. put all these sanctions on Russia, every sanction you can think of, they've failed. But one of the reasons was they had gold, and Russia has actually made $50 billion in mark-to-market profits on their gold reserves. So on the one hand, here we are stealing their Treasury securities, but by doing so, we're helping to create geopolitical risk, drive up the price of gold. And Russia has at this point, more than $50 billion profit on the gold. So kind of what goes around comes around. Now, here's the thing. From a gold investor's point of view, I like this. This is what is called an asymmetric trade, meaning with a central bank buy, you have a floor. It's not a hard floor. There's no guarantee, but you have a de facto floor under the price of gold, but you have unlimited upside. So you can buy gold with some confidence that it's not going to go down a lot because the central banks will just buy it. At the same time, the sky's the limit in terms of where it might go. So it makes gold a very attractive trade. I should be clear, we are not at the frenzy stage yet. This rally has a long way to go. And the reason is it is a precious metal, exactly as you described, Jordan, but it's also an industrial input. And so the price moves on both vectors. So as a precious metal, I do expect it to go higher. There's no way that gold is going to double or triple, and silver won't be along for the ride. So you can see $100 silver at some point and even higher from there. But at the same time, if we're going into a recession, which I expect we are, and manufacturing is declining and everywhere from China and the U.S. as well, Europe, all over really, then there might be less demand on the industrial side, although it's demand for electronics is still strong. So you've got sort of two forces. It's going to go up on the precious metals vector, but maybe lag a little bit in terms of the industrial input vector. But on net, I do expect silver to go up.
Do you think central banks' move toward gold signals the beginning of a new monetary order? Could silver outperform gold in the years ahead as industrial demand recovers? If you have any comments, please share them here. In order to receive our latest updates, please subscribe and leave this educational video a review. We appreciate you coming along on this journey.